What if one day, your money still looked the same? The same dollar bill, the same number in your bank account, the same paycheck every month. But slowly, silently, it bought less and less. Less food, less fuel, less rent, less freedom. And the strange part is, this does not happen overnight. It happens quietly. One price increase at a time. One stimulus package at a time. One crisis at a time. And behind it all, there is a machine. A machine that never sleeps. A machine that creates money when the system begins to shake. This is the story of why America keeps printing money, and why the real danger may not be the money itself, but the trust behind it. For most people, money printing sounds simple. A government needs money, so it prints more dollars. But in the modern world, money is not always printed on paper. Most new money is created digitally. It appears as numbers on screens, inside banks, inside financial systems, inside government programs. The Federal Reserve does not simply run a giant printer every night. Instead, it influences the supply of money through interest rates, bond purchases, lending programs, and financial tools that most ordinary people never see. But the effect feels the same. More money enters the economy. More dollars chase goods, assets, services, and debt. And once that happens, the value of each dollar can slowly weaken. Money is powerful because people believe in it. A dollar has value because people trust that tomorrow, someone else will accept it. And suddenly, the entire system begins to freeze. In those moments, the government and the Federal Reserve face a terrifying question. Do nothing and risk economic collapse? Or inject money and risk future inflation? Most of the time, they choose the second option. Because in the middle of a crisis, printing money feels like survival. During recessions, money is used to stimulate the economy. During wars, money is used to fund defense. During financial crashes, money is used to rescue banks. During pandemics, money is used to support households and businesses. It is the emergency button of the modern economy. And once a country becomes used to pressing that button, it becomes harder to stop. In 2008, the financial system nearly collapsed. Banks were failing. Housing markets were crashing. People were losing homes. Fear spread through Wall Street like fire. To prevent a complete disaster, the Federal Reserve lowered interest rates and injected massive liquidity into the financial system. The message was clear. The system would be saved, no matter the cost. Then came the COVID era. Businesses shut down. Millions lost income. Entire industries froze. The government sent stimulus checks. The Federal Reserve expanded support. Trillions of dollars moved through the system in a short period of time. At first, it felt necessary. It is the feeling of earning more, but saving less. It is the quiet destruction of purchasing power. And for the middle class, this is where the pain becomes personal. Because the rich often own assets, stocks, real estate, businesses, gold. When money is printed, asset prices often rise. The wealthy may become even wealthier. But ordinary workers usually hold cash, wages, and savings. And cash is the first thing inflation attacks. A dollar saved today may not buy the same tomorrow. That is why inflation feels invisible in the beginning and brutal in the end. The middle class does not collapse in one dramatic moment. It gets squeezed. Slowly, rent rises. Medical bills rise. Education costs rise. Food costs rise. Credit card balances rise. And at the same time, savings disappear. This is the hidden cost of money printing. It does not affect everyone equally. Some people are protected by assets. Others are trapped by wages.